This is Jeff Bezos. You may have heard of him. In 2011, Jeffrey had a bad year, reporting barely any income on his tax return. Thankfully, the government stepped in, giving Jeff and his family a $4,000 tax credit to help pay for his kids. The government's generous contribution, there for the families that need it most, helped Jeff make ends meet, with his paltry value of $18 billion that year. Jeff is not alone. Dozens of billionaires across the United States report minuscule income, paying almost no taxes, and even receiving government aid in some instances. And while politicians and personalities point the finger at the billionaires and paint a picture of secret offshore tax havens and shadowy accounting tricks, the reality is that the vast majority of the ultra-wealthy are avoiding taxes simply, legally, and out in the open. While calls go out to make the ultra-wealthy pay their fair share and tax the rich, the question of how to do that is not so simple. It involves completely reimagining tax law, fighting against a tsunami of billions of lobbyist dollars, revitalizing a useless and gutted IRS, and redefining what income even is. If you are an average American, you receive a paycheck. From that check, deductions are made for Medicare and Social Security, and then at the end of the year, you report your income and are taxed accordingly. The United States has a progressive system, meaning the more you make, the more you pay in income tax. For the ultra-wealthy, in the top bracket, the amount is 37% of your income. In 2021, ProPublica obtained a year's worth of tax records from the IRS in a leak, and used those rarely public records to calculate what they called the ultra-wealthy's true tax rate, a percentage of how much taxes they paid versus how much their wealth increased in that year. They concluded that the 25 wealthiest people in America paid a tax rate of only 3.4% between 2014 and 2018. How is that possible? Quite simply, the ultra-wealthy do not have much income. You may recall when Donald Trump became president, he declined the salary. Maybe a nice move to save taxpayers money, or maybe a calculated move, as salaries are a dangerous game for the wealthy. Many CEOs of huge companies have only modest salaries. Jeff Bezos, for example, has had his salary capped at $80,000 for years. Other CEOs have a salary of $1. Salaries are traditional income, and that income can be taxed. There are several ways that the wealthy avoid this. The fact is that the majority of billionaires' net worth isn't liquid, it's tied up in assets. Those assets may be shares of a company, it may be real estate, it may be a sports team or other entity. In the United States and most of the world, held assets are not taxed until their gain is realized. That means you cannot be taxed until you sell something. So if you hold the majority of the shares in a company you started and the value of that company goes through the roof, so does your net worth. But you don't receive any actual income, and so you can't be taxed on it. But then you may ask, how do billionaires afford their extravagant lifestyles if all of their money is tied up in assets? The answer is a cycle coined buy, borrow, die. The first step, buy, we just covered. Get yourself an asset that is worth something. Then borrow against it. If your shares are worth several billion dollars, it's easy to convince a bank to give you a loan in the amount of hundreds of millions or even $1 billion, as long as you can use your shares as collateral. The loan may carry interest of 3%, say, which is vastly better than paying 37% in taxes from income or 20% from selling stocks and losing some control over your company by liquidating shares, especially considering that you can write off your interest payments, further reducing your income. This is in part how some billionaires have had recent years where they paid zero taxes and received government assistance payments designed for low-income families. The die portion of buy, borrow, die involves a series of accounting tricks and trusts the ultra-wealthy use to avoid estate taxes when passing on money to their heirs. We won't get into that in this video, but suffice to say, it allows generational wealth to grow in a way that skirts the taxes specifically put in place for estates over $11 million. Avoiding income entirely may be job number one when it comes to evading taxes, but it isn't always possible. Thankfully for the rich, a tax-free haven exists where billions of dollars can grow legally without ever paying 1 cent of tax. It's not in Bermuda or Malta, it's at home in the United States. In 1997, the Clinton administration passed a law establishing the Roth Individual Retirement Account, a new type of account envisioned by Senator William Roth Jr. The account was a tax-free retirement account designed for the middle class. Once money was put into the account, it would never be taxed, as long as you waited until you were at least 59 and a half to withdraw the funds. The government put some safeguards in place, immediately seeing how this account could be abused by the wealthy. They capped yearly deposits at $2,000, they've since gone up to $6,000, and prohibited Americans making over $110,000 per year from opening one. As we know, the rich would never be able to find a loophole around protections like that, right? In 1999, a young man named Peter Thiel was working on a company that would one day become PayPal when he was told about the Roth IRA. He and his accountants came up with something ingenious. Thiel deposited a little under $1,700 into a Roth, then used that $1,700 to purchase shares in his own company, which was then private so he could set the cost for 1/10 of a cent each. This was the last time Thiel would contribute to his Roth. Shortly after Thiel bought his shares, millions of dollars poured into PayPal from outside investors. Just a year later, based on the growth of PayPal, his Roth was worth $3.8 million. In 2002, after eBay had purchased PayPal, Thiel sold his shares, still inside the Roth, bringing it up to a value of $28.5 million, completely and forever tax-free. Had he sold his shares normally, they would have been taxed 20% by the IRS and a further 9% by the state of California. Thiel repeated the process, buying shares of Palantir and later meeting some guy named Mark and giving him $500K for a little company called, let me check my notes here, Facebook, all inside the Roth IRA. Peter Thiel's Roth is now worth $5 billion, meaning in a little over 20 years, Thiel turned $1,700 into $5 billion without ever paying 1 cent in tax. Now, because of some law changes, anyone can convert their normal IRA into a Roth by paying a one-time tax, a choice that many of America's wealthiest people are choosing. Thiel has used the Roth better than anyone, but many of the other 25 richest people in America own Roth IRAs in the hundreds of millions of dollars. There are many other tools in the Legal Tax Evasion Handbook. Buy a sports team and write off everything as an expense. Reclassify your income to something that is taxed at a lower rate. Use real estate trusts to avoid paying estate tax. The list goes on. And while I said at the top that billionaires do all these things simply and legally, that isn't always the case. Many of the ultra-wealthy skirt the line of legality all the time, not to mention the ones who have their money in illegal offshore accounts. But the United States is generally powerless to do anything about it. Why? Because of a systematic and deliberate gutting of the IRS that left the agency broke and impotent. The IRS has never been popular, but starting in the 90s, Republicans began to call for changes to the agency, even as strongly as advocating for it to be abolished altogether. In 2010, the Obama administration passed the Affordable Care Act, or Obamacare, and as with any huge government project, they needed the IRS for it to be effective. This allowed Republican lawmakers to kill two birds with one stone. If they could gut the IRS, they would be able to hinder Obamacare at the same time. The result was millions of dollars of cuts to the IRS over the next several years, causing some stark changes to the organization. Between 2010 and 2017, the IRS lost a third of their auditors. In that same period, the number of people investigated for not filing their taxes dropped from 2.4 million to 362,000, resulting in about $3.8 billion in lost revenue. Enforcement for people who do file their taxes but don't pay also dropped. If the IRS doesn't go after someone for not paying their taxes for 10 years, those taxes are lost. In 2010, that amount equaled $462 million. In 2017, it was $8.3 billion. Some estimates put the annual revenue lost because of IRS cuts at $18 billion a year. It also changed who the IRS focused on. Auditing a large corporation, an offshore tax haven, or a wealthy individual is expensive, time-consuming, and complicated. As the IRS lost resources, they lost the expertise to complete those types of audits. Instead, they changed their focus to auditing another demographic, the very poor. In 2017, 36% of the IRS's audits were of people who received the Earned Income Tax Credit, an anti-poverty program for people making under $20,000 a year. That same year, the IRS audited only 2.5% of people making over $500,000, down from 8% in 2011. Things are changing for the IRS. In August of 2023, the Democratic Senate passed their climate, health, and tax package that included nearly $80 billion in funding for the IRS over the next 10 years, with more than half of it dedicated to enforcement, specifically to go after corporate and high net worth tax evaders. It's estimated that the improvements will bring in over $200 billion in revenue. It will take several years for the effects to be fully seen, however, plenty of time for the funding to be reversed and slashed once again. So the question remains, if it is so easy and legal for the ultra-wealthy to avoid taxes, what is the solution? Many countries have adopted a wealth tax, taxing individuals a certain percentage based on the value of their held assets. However, wealth taxes are difficult to enforce, in part because there are ways around them, and also because ascertaining the value of assets can be expensive, difficult, and time-consuming. France recently abandoned their wealth tax, in part because it was difficult to enforce, and in part because of the age-old dream of trickle-down economics. The simplest, in theory, is to tax unrealized gains, meaning assets that have appreciated in value but haven't been converted into cash yet. This again would require a well-equipped IRS to enforce. It could also have a lot of unpredictable effects. If the ultra-wealthy were taxed for their unrealized gains, they might potentially need to liquidate assets to cover the tax bill, perhaps resulting in them holding fewer shares in companies, fewer real estate holdings, and so on. Depending on your politics, you might see that as good or bad. In our culture, billionaires are reviled by many, and maybe that's fair. But when it comes to taxes, it's hard to hold it against them. Who among us, when presented with a laundry list of simple, legal, universally adopted ways to avoid taxes, would choose to pay them instead? Politicians choose rallying cries that are catchy and easy to remember. Tax the rich, make them pay their fair share. A lot of people agree. But whether it be a mountain of loopholes, an ineffective enforcement agency, or the very definition of income itself, there are just too many ways for the ultra-wealthy in our society to sidestep the rules that we all play by, and too few meaningful solutions that any politician is willing to try.